Hey everyone, this is Dr. Duru from Ahan Analytics with the market breadth. All right, so last week I talked about a nervous calm in the stock market. Now I think we've transitioned to a more confident calm. The big news today, and the timestamp is June 27th, 2025, is that we finally have gotten back to new all-time highs for both the NASDAQ and the S&P 500, something I didn't think was possible this quickly, even as much as a month ago. But here we are. So let's take a look at the big headlines. There's really just one big headline I think that matters for the charts that I'm about to show, which is this late breaking news that the US and Canada, well, I guess the US broke off trade talks with Canada. So that trade, I guess, pause is back off. I don't know how to quite say it, but let's not be surprised. There's a lot going on with all of this tariff trauma, drama, and noise. So there's bound to be some big setbacks like this one with Canada. And as I saw you in the charts, the market's response kind of proves that the confident calm is here. Some other big headlines, of course, Nvidia's breakout, I kind of think led the way for this new all-time high. And then we also have Tesla had some more self-driving news. Didn't really affect the stock much. In fact, the stock is underperforming the market big time in recent days. And I think there was one other headline. Let's see. Oh, right. And then the ongoing developments with the budget bill are important because I believe President Trump wanted to get this done by July 4th. And so there's basically just a week left. So the scramble is on, and we'll see a flurry of headlines. Some of them might be market moving, but I don't think anything's going to move the market permanently. Okay, so let's actually go first to the market recap on Swing Trade Bot, which is a stock scanning tool. It's my favorite, and I'm a big fan, and I am a subscriber. I just want to confirm that, because we're at all-time highs, guess what? All of the trends are now pointing up, except, of course, I should say, of course, the small caps, Russell 2000 is flat long term. And of course, when I get to the charts, that'll be easy to see. But otherwise, everything is flashing green. All systems go. All right. You can see here, new highs dominated new lows big time. And, here's the heat map. It's actually not as green as I would expect. And when I get into the charts again, you'll see some of the impact of this, which is that market breadth actually is lagging and created a kind of bearish divergence with the stock market. So that's a yellow flag, and we'll get into that in a few seconds. So hold on here. And let's see any big technical signals. This is interesting. A lot of stocks hitting their 20-day moving average resistance. So this part is probably part of the bearish divergence that I think is unfolding in the market. This is something that's worth taking a look into this weekend for myself. And I think that's enough for now. And before I continue, remember, share, like this content so that the algorithm knows what's up. If you have any comments or questions, put them down below. Feel free to subscribe to this channel so you can get alerted whenever new videos come down. And remember, I post these for your educational purposes. Please invest and trade according to your own risk tolerances and time horizons. Okay, let's jump into the charts. And let's go right into, actually, let's not look at Carvana. Let's go right into my favorite technical indicator, which is the percent of stocks trading above their 50-day moving averages, otherwise known as AT50 or above the 50. And this is what I'm talking about here, which is, again, according to the AT50 trading rules, whenever this market breadth indicator drops out of overbought conditions, and overbought is at the 70% level, that's bearish. And as I've been saying over and over and over again on both my blog, which is drduru.com/122 all letters, and here on the videos and shorts, that the market is well supported. So I use discretion. I hate using discretion for trading rules, but I had to do it here because I thought there was a bigger rule in play here, which is that support was just very firm underneath the stock market. So it made no sense to flip bearish. And that remains true even as market breadth is now continuing to struggle to get back into overbought territory. Now, again, remember, when the market flips to overbought, it is not necessarily bearish. In fact, I no longer consider it bearish. I consider it a sign and a confirmation that buying power in the market is strong. It's only when the market falls out of overbought conditions do I think of the market as losing some buying power. So now, as the market breadth struggles to get back into overbought territory, that raises the yellow flag for me and tells me, hey, the market or the buying power is not as strong. And as you saw in the heat map, there was plenty of red today, which means that there are plenty of stocks that aren't, there are a sufficient number of stocks that aren't participating in these record all-time highs in this big celebration. So that's the yellow flag, but there's again no reason for me to get bearish. I haven't even flipped my short-term trading call back. I haven't even downgraded it to neutral. It remains cautiously bullish. Let's take a quick look at the cousin percentage of stocks trading above their 200-day moving averages. You could see it finally broke out to a more multi-month, a new multi-month high, but it too is it's lagging a lot. I mean, I would prefer the market to be hitting all-time highs with the percentage of stocks trading above their 200-day moving average to be at least 10 to 15 percentage points higher than where it is now. So there are a lot of stocks that are not participating in these all-time highs based on even just this longer term indicator, right? You can't be at all-time highs and also be under your 200-day moving average. So at least half, sorry, more than half of the market is not participating. That is not good from a market breadth standpoint. So we have our warning, but there's nothing yet to act on unless you have very specific individual cases with individual stocks. All right. So let's jump into the indices. Of course, let's start with the S&P 500. And let me go back to logarithmic. And you can see here, you can see, let me zoom in a little bit. This is the dashed line here. The green line has now surpassed the last all-time high, which was on February 20th. The S&P 500 closed at 6173.08. It was a fractional gain, but that's all we need for a new all-time high. Yesterday was a teaser where it closed right below the all-time high. Now, there is a warning here. This is not a rally to chase for two reasons. One, we had a open above the upper Bollinger Band and a close above the upper Bollinger Band, and that's this black line which defines price volatility, um, expected price volatility. And this tells me that price action is getting a little stretched. So if as soon as next week we get a pullback, I won't be surprised. And if I flip to the 15-minute chart, you'll see why I'm also a little suspicious about today's action in terms of it holding in the very, very short term. When the news dropped that trade talks with Canada collapsed, we had this is the 15-minute candles. Basically, the sellers just took over and basically put the market, reversed all the gains for the day, but they could not press any further. And this is where the market's confident calm came in because the buyers, pretty much, I'm sure, robots stepped in almost automatically and just started buying the dip. So, there's going to be this tension between these robots and traders who just automatically buy any dip on any bad news, quote unquote bad news, and then the tension of only a few stocks participating in this buying power that represents the new all-time highs. So that's going to be the tension to keep an eye on, in the coming days and weeks. NASDAQ, similar story, new all-time high. You can see it's also stretched above the upper Bollinger Band. In fact, the last 4 days, it's either tapped or closed above its upper Bollinger Band. So this is already quite stretched for a run. And let me just go back in history so you can see why it's not an automatic bearish sign, but the resolution of these things usually does end in some kind of pullback and sometimes significant. So here was November. You could see how the NASDAQ 4 straight days closed above or right on the upper Bollinger Band, and then the resolution was a whoosh right down to the 20-day moving average support, which is that dotted line. We had here, this is a much milder example. And here, this is again a very mild example. Okay, so all that to say that we are sure the history says to expect some kind of pullback. We don't know how sharp it will be and how dramatic it'll be. But again, the market is well supported, so I'm not worried about the any kind of pullback that comes just from the pure technicals here. But if it's because of market breadth, then I am a little bit more worried. So IWM, this is something that does worry me a little bit. This ETF of small caps, the iShares Russell 2000, it was flat on the day, so it once again is underperforming. It had a great day yesterday, 1.6%, which outperformed the market. And the reason why I'm a little worried is, it did break out above its 200-day moving average, but only by a sliver, and it faded back, right? And it didn't come back as much as the other indices did. So this 200-day moving average breakout remains is lingering out there to be confirmed. I did not buy any call options. I'm just going to wait until I see what happens on Monday before I make a play. I did load up on call options on this test of the 20-day moving average, and that worked out very well. Particularly here is where I sold on Tuesday, June 24th, when IWM made its first run at the 200-day moving average. Okay, now the VIX, the volatility index, also shows a very confident calm. You can see the pre-tariff low has been broken now. Before it served as a launching pad for the last sell-off or pullback. This time, the sellers could not take advantage of this test, and the VIX has dribbled even further lower. Some people would interpret this as being overly complacent. Yes, it's a sign of complacency, but it's also, even more importantly, a sign of just how strong the buying power is. So I'm not going to worry about it until it's time to worry about it. Okay, now I have a long list of individual stocks, as you can imagine, on a day like this or week like this. There's just a lot going on, so bear with me. You can fast forward as you need to. You can even drop off now. Just make sure, again, you like, share the content, comments, and questions below, or subscribe to the channel. Let's get started. GLD, or the Spider Gold Trust. This is a big one. This is another point showing the confident calm in the market, right? GLD has finally done a clean break below the 50-day moving average. It hasn't closed below the 50-day moving average since the beginning of the year. So this is a big moment. I did, of course, have a call spread going because I was playing the test of the 50-day moving average support. It didn't work out. And now, again, just purely technicals, I know to leave GLD completely alone until it hits the next support line, which is the last test on the 50-day moving average support, which is May 16th, around, what was that, 293, or in the deep pullback case, going all the way back to this 200-day moving average support, which would be around, let's just call it 270. But that's well off. That's like a 10% pullback. So that's a full out correction. I don't think we have a case for a full out correction in gold because there's still a lot of catalysts out there to keep people in their positions. But from a trading perspective, I don't see a need to buy GLD here. And of course, I would buy if it broke out above the 50-day moving average. So that would be buying on strength. Okay. All right. Let's take a look at some other individual stocks very quickly here. Lemonade, fintech stock. The reason why I put this in here is because let's pull back here. It been choppy in trading, and of course, is well off its all-time high. But it looked like it was going to make a run for its last high back in November. But it pulled back sharply, and now I'm looking at, can it hold this 20-day moving average support, the dotted line, before making a buy? We will see. Oracle, I put this on the list because it had a huge earnings. I forgot to cover this last week. It had a huge earnings jump last week. It jumped, what was this, 13.3%. Followed that up with an incredible 7.7% move. Again, here is the upper Bollinger Band in action. You can see how these two closes were well above the upper Bollinger Band and created a stretch condition. Fortunately for Oracle, it has not created a big pullback. Instead, the stock is now cooling off, what I like to say, cooling off and consolidating. So now that it's well off the upper Bollinger Band, if it breaks out above this high, I think that's an all-time high, I'm willing to just jump in and buy strength. So we'll see what happens. As always, that's my attitude. Let's see, Duolingo. also caught my eye and have to wait for the computer. Okay, here we go. Here we go. Duolingo. Duolingo caught my eye because this has been what I like to say fan favorite, and this is now underperforming the market. You can see that for most of June, it's sold off. This caught my eye because the last earnings report, which was in early May, the stock soared 21.6%, and buyers continued to send the stock higher. And yet, now this week, that gap has been completely filled. So, this is a time when I would look to buy a stock like this because I'm assuming, I have to look into more details, but I'm assuming nothing fundamentally changed between this strong earnings reaction and the pullback. But I don't want to buy it here just because it's in no man's land. It's between the 50-day moving average and the 200-day moving average. So it's a spot where, sure, it could rally, but it might hit resistance and stop cold, or it could just continue to sell off until it hits this stronger support line. Why do I call the 200-day moving average the stronger support line? Because it held up Duolingo during the tariff drama, trauma, and noise back in March and April, and it held a support as far back as last September. All right, so that's Duolingo. Let's go to ARK. This is a big one. I, you know, let's see, I am missing my overlay. There we go. There's the overlay. So, I wrote excitedly about ARK way back when it made this breakout back in, what was this, in December, because ARK finally got above its pre-pandemic high. And let me just pull back to show you why this is important. This was its pre-pandemic high, the bubble, it crashed. Once it crashed below that pre-pandemic high the second time, it never recovered, and ARK has never been the same. So it is basically, since the pandemic, just lagging the market big time. But I've kept my eye on it because I don't want to miss out, because I suspect Kathy Wood and team will get their portfolio together, and you can see that they are slowly but surely repairing things, or at least this is what I assume. Because after this breakout, and it fooled me, of course, because I bought in some and it proceeded to collapse, particularly because of the tariff drama, trauma, and noise. But then it's been rallying from the April lows nearly straight up. And of course, I bought more because I think I wrote about this or talked about this before, that I took this signal of a breakout as being the first sign or first step to a fundamental change in behavior. And I think this second breakout has proven me correct, because ARK did manage to motor even to fresh highs. So, along the way, I've also traded in and out of ARK successfully because this trend has supported, short-term trades as well as more intermediate trades. So I'm just pulling that up as a reminder that this is probably one of the more this is one of the ETFs that I'm most bullish on, ironically enough, given my past criticisms of this ETF and others like it. But it struggled this week. It just churned, and so looks almost like it's ready to underperform the market again. You could see it fell down a full 1.7% today, and so that's direct underperformance. That gives me a yellow flag. Okay, DoorDash. This is a this is one I was bearish on a long time ago. I gave up on my bearishness. Various times I've tried to trade from the bullish side, sometimes successfully, not successfully. When it broke out to new all-time highs, I finally gave in. And actually, I didn't buy here. I think I bought some. Yeah, I bought on this small, tiny, tiny pullback on Wednesday. And oh, actually, no, sorry. Oh, sorry. I either got bought then or I bought the day before. Regardless, my point is that I was buying into strength because DoorDash has really proven itself over time. There's just no denying it. I mean, if you just pull back, look at this. If I had just stuck with the theme back when the bear market ended, this would have been a huge performer, a multiple bagger, as they say. And now I believe DoorDash has hit all-time highs. Maybe, well, let's see. 245. Oh no. Okay, so it's testing all-time highs. Um, and so I just wanted to buy in here because if it breaks out to an all-time high, I think DoorDash could just zip higher, assuming again the general stock market is also bullish. So I bought a few shares, I bought a little bit amount of shares. I just want to see if I could participate. Again, this is one of these changing character plays. So even if the stock pulls back from here, I'm not selling unless, of course, it makes a major breakdown, which is say below the 200-day moving average. I'm considering this a long-term holding. And why the 200-day moving average? Look at how perfectly DoorDash tested it during the tariff drama, trauma, and noise. Absolutely pin perfect test. I should have been a buyer there. I didn't. And now, all I can do is just get in super, super late. And just like I think that was Duolingo I was talking about, the 200-day moving average has provided strong support, has guided the stock higher ever since late last year, or so I should say the fall. Okay, next one. Just a quick touch up on Novo Nordisk. I've done some shorts on this. I'm not going to belabor the point here, which is thank goodness I did not bail on a simple 50-day moving average breakdown. There was no follow through for the sellers, and Novo Nordisk, ticker symbol NVO, has dribbled its way back to the 50-day moving average as resistance. So, as I mentioned in my short, I don't even have my stop loss until about 63. I was exact $63 because I was exactly afraid of this kind of situation because it looks like there's just a lot of technical trading going on, trying to shake out sellers, shake out buyers, and whatnot. So I want to have a loose leash on Novo Nordisk. Okay, here is MongoDB. It's a NoSQL database provider. Its technology, I think, is falling out of favor. Somehow it managed to gap higher post earnings earlier this month by 13%. But then it just sellers just took over and completely filled that gap. Now notice how the 20-day moving average is held perfectly as support. I'm so tempted to buy this, but I have a friend of mine who's just been waving me off. He thinks this is dead money, so I'm taking his advice. But I still wanted to point out this chart because I just love the way that technicals can be such poetry as a way of understanding what the true the supply and demand dynamics are for a given stock or ETF or the stock market as a whole. So I wouldn't consider, you know, a MongoDB, ticker symbol MDB, to be making a bearish to bullish reversal until it manages to get above its 200-day moving average. Not to mention the stock is lagging the stock market big time. I mean, it set its all-time high way back in 2021, and then it tried to make a run at it in 2024 last year and failed. So this is a major laggard stock. It's only for short-term trading in my book. Okay, let's look at Equinox, which is a um, data farm kind of place. Oh wow. It's shame on me for not staying on top of this situation. I actually noticed this big sell-off on Wednesday of 9.1%. And I believe Equinix was downgraded by some analyst shop. And I put it on my list as a potential short because it sliced right through the 200-day moving average and 50-day moving average supports. But clearly, I was too slow to think about what to do about it because the very next day on Thursday, ticker symbol EQIX, fell another 10%. Now, it was today, that was obviously a very overextended move. The stock gapped below its lower Bollinger Band, and it closed even further down below. So today's gap higher and rebound doesn't surprise me. It gained 5.3%, but I suspect this rally is one to be faded, is one that I'm going to fade. But I need to look into more details on all the news and the chatter going on this one. And you can see how very conveniently the buyers stepped in before, right as Equinix, sorry, not Equinox, Equinix was testing the lows from the tariff drama, trauma, and noise. So this is one to watch. I like also keeping stocks like this on the list because it can serve as a way to hedge bullish positions. Okay, let's take a look at MasterCard. This is one where it gapped down and I jumped in on a call spread. It initially sold off last week based on news about some stable coin moves, I think, by Walmart and Amazon. So the fear is that big retailers are going to move away from the credit card payment systems provided by MasterCard and Visa and others. You can see here, perfect test of 200-day moving average support. I was too slow. I missed this easy trade. Because MasterCard is a well-loved stock. It's going to take a long time for people to be convinced that they need to get out of this one. And let me just pull back so you can see what I mean by well-loved stock. This is one you put in the drawer and just hide it and don't look again for 5, 10, 15, 20 years. So it's a little early to say that MasterCard is done. And this hold at 200-day moving average support says there's a lot of people that also do not think MasterCard is done quite yet. So, I missed that move. I missed that support. When it fell off a 50-day moving average resistance, I took a chance. I did a call spread just in the hopes or expectation that this bounce is going to hold at least for a short-term trade. I'm basically even at this point, and we'll just see what happens. Now, on the flip side, we have Circle Internet Group, which is is a stablecoin platform. And I wrote about it in my blog and I said, the stock, I wish I'd gotten in earlier. I now understand the importance and basically the earth moving um, technology that stable coins represent. Like this is going to be the way of the future in some form or fashion. But this stock is just gotten so far ahead of the reality. I think their margins have to be razor thin. The margins on platforms are razor thin, and there looks like most of their money anyway is going to be made on the carry on treasury bills. So that's like, picking up pennies off the street, pennies and nickels. So anyway, I'm not going to make too much of the fundamentals because the technicals rule the day here. And I did write on my blog that it was just way too overextended for me to even consider buying. And now look at this. It spent most of the week pulling back. It's pulled back sharply, I think, from this intraday high. Yes, it was around 300. Now it's pulled back like about 35% just this week from that point. This is a stark lesson in not chasing. I mean, I know it seems odd to say don't chase when chasing actually worked earlier in this move, but you just never know when these pullbacks are coming. You just know that they have to come because nothing grows to the sky like this, and just these overheated moves that go straight up just aren't sustainable. And now because it went straight up, there's very little natural support for the stock to stop at. So for the next natural support I'm looking at for a CRCL is about 150. But the average, I think when I wrote about it in my blog, the average closing price for Circle was 135, and that just happened to be a closing of this gap. So I don't even want to buy at 150. I'll consider it at 135, but only if Circle bounces off of that support. I just can't be confident that any of these supports can hold well just because of this hot, hot, hot read going straight up. Okay, let's go on to, oh yes, Fiserv, which is also part of this story. Now I was surprised because Fiserv and I think MasterCard are teaming up for this stablecoin play. But it rallied, but then it hit the 50-day moving average as resistance. So it's still bearish. You can see that it's fallen hard off of its high earlier this year. In fact, at one point, it looks like, yeah, it was headed almost for, um, let's see, about a 35% pullback. You can see it held support all the way going back to last summer. So I am, this huge drawdown back in May is pretty bad. So it's not a buy for me until or unless it breaks out above that. So just breaking above the 50-day moving average resistance won't be enough to interest me. But anyway, I just thought I'd point out Fiserv, ticker symbol FI, as something to keep on that I will be keeping an eye on. Not from the bear standpoint, but just to see if the stock repairs itself and gets bullish again. Okay, Snowflake, another database play. This caught my eye because you see this pinch here on the Bollinger Bands. It's called a Bollinger Band squeeze. It broke out to the upside, so that is a bullish resolution. Snowflake, of course, is still well below where it used to be back in the bubble days of 2021. It had actually this massive, massive double top up around above 400. So now it's trading a little more than half of that, and it still hasn't even gotten above the high from 2024. But this is a very positive and bullish development. So I'm just looking for a nice spot to buy into this. I would love to buy on a pullback to the 20-day moving average support, but we will see what happens. And how could I forget Nvidia? I should have led with Nvidia at least after gold. Nvidia, like I said, is the big news. It helped to bring to parade the market into all-time highs. This was back on Wednesday. This nice breakout, June 25th, was the yes, this was the all-time high. I went ahead and bought one of my classic vertical call spreads where the long is expiring on Friday. Sorry, the short side is expiring on Friday, and the long side is expiring either next week or the week after that. It's a play on assuming that people are chasing too hard on a stock, and that the premium in the shortest dated call or put, if it's a downturn, if it's a bearish play, is overheated and will evaporate very quickly and much faster than the long side. That's exactly what happened with Nvidia. I bought I think a 155 strike. It actually closed out with a profit yesterday as the stock bounced around. And this is another reason why I like these sorry, this is not a vertical call spread, a calendar call spread, because I can, in a day of volatility like this one for Nvidia, let me just zoom in a little bit. It moved between like 154 and let's call it 57. At some point, yes, I might be down, I might be up, but at some point my initial profit target could be taken out, and that's exactly what happened. Although I do want to have a more standing position because Nvidia has now invalidated this last bearish engulfing top. This stock really loves bearish engulfing tops. With this invalidated, it means that Nvidia has a clear runway to run much higher. Who knows where it'll next stop? Maybe it'll get to 200 this time. So I need to have a piece of this with sooner than later. Okay, let's keep it moving. Toast is one that caught my attention. This is an IPO that I'm surprised that it's been doing this well, given its space of providing restaurants with payment and I think, yeah, payment platforms essentially. It caught my attention because it had a big down day on Wednesday of 7.1% and it rebounded right up. So this tells me that there's something shaking and rocking after the stock, it had a great earnings move, 11.4%. And now there's a lot of indecision here as the stock digests that move. I want to be there long if it breaks out above. If it comes down below, you can see how perfectly it tested the 50-day moving average support. I really should have been there as a just experimental buy, but I wasn't there. I'm not sure on a pullback whether I want to buy it there again because I think if it pulls back again, it's going to be a gap fill moment. So that's all the way down here. That would converge with the 200-day moving average, where I'd be much more comfortable buying it on a pullback, buying on weakness. Okay, so that's Toast. Domo is one I'm really excited about. Um, I've written and posted about this enough times. I'll just say that I finally bought some shares. I bought it on this pullback here on Wednesday. The stock have rallied the next day 9.5%. It rallied again. It has a partnership, I think, with I'm forgetting the partnership it just signed with some major tech company. But I think it's just a sign that Domo is making a bearish to bullish reversal. Let me pull back so you can see what I'm talking about. Domo is so far off of its all-time highs. During the bubble days, it got all the way up close to 100, and now it's really struggling. It looked like it was dead money and a dead stock all throughout last year and most of this year until this big earnings move. And so now I think a bearish to bullish reversal is on its way. I'm also a user of Domo. It's an analytics platform. They've really made some great improvements over the last 3 years. So I'm pretty much putting my mouth where my money where my analytics consultancy is. So I'm excited. That's why I'm excited about this, where I can pair sort of my knowledge of a product with an investment that's working. So hopefully this will continue to work for months to come. I've lamented about Spotify plenty before. I will just say that, yeah, lamenting is not good enough. Execution is much better. I missed so many obvious opportunities to just jump into this great uptrend, this epic uptrend. I'm just pulling back here. You can see since the bottom in 2023, Spotify has pretty much gone up 10x. I mean, it just made so much sense to buy this at some point anywhere along that trend. It made sense to buy this abandoned baby bottom. It made sense to buy when that bottom was tested and the stock rebounded over there. It made sense to buy it on the 50-day moving average breakout, although I can understand being having some trepidations against ahead of earnings. And it made even more sense to buy Spotify after the stock recovered all of those post earnings losses and then started to rally. So all I can say now is I have to just stay on top of this better and look for the next pullback. Who knows? And of course, given this run up now, I prefer to buy on a test of 50-day moving average support, not just the 20-day moving average support. Okay, Best Buy, electronics retailer. I wanted to point this one out because it is major lag. It's a major lag. The stock made a valiant comeback, reversing its post-earnings loss of 7.3%. I have no idea why buyers got excited about Best Buy, and sure enough, the sellers took the stock right back to the post-earnings lows. And now the stock is turning around. I do have a put spread position that I actually bought way back here. It's going to expire in July. It doesn't look like it's going to win out, but regardless of how that trade plays out, Best Buy looks really bad. And it's a warning sign on the retail side, just given at least the way the technicals look for Best Buy. All right, Intuitive Surgical, we're almost done. Intuitive Surgical, ticker symbol ISRG. I did a short on this one as well. This position has survived this big downgrade. You can see here, buyers bought right off the intraday low, took it back above support at 50-day and 200-day moving averages. Then the sellers took over again, but they never could pierce that intraday low, and the buyers took over again, and now it's back above converged support at the 250-day moving average. That was a mouthful to say. I'm glad I'm sticking with Intuitive Surgical. And again, I did a short on this. I've written on this for additional details, but just suffice to say that this is another case where just paying close attention to the technicals and being very disciplined about where the exit point made sense worked out. Worked out so far. And let's see, how should we conclude this? I'm looking at my list. Let's go with, we've done so much already. Oh, yes, McDonald's. This was interesting. So this is a case of just me being late. I didn't notice that McDonald's had broken down below the 200-day moving average. This was a big time bearish sign. It only was dropped at 2%, but still, it warranted a bearish trade. By the time I noticed it, it was already down here. I went ahead and said, let me just go ahead and speculate just in case the sellers continue. Of course, they didn't. And the buyers stepped in, but then there was a continuation selling move on Wednesday. Uh, So I thought that the continuation, this confirmed the bearish move on the stock, but then it soared again 2.1%. So now I think this whole bearish move is coming to an end. I expect McDonald's to rally at least back to resistance levels. You can see how the 50-day and the 20-day moving average are both trailing downwards. So there could be a major convergence and major test of resistance coming up. Oh, I did want to spend just a quick minute on the um, forex or currency, given the news that trade talks collapsed between the US and Canada. I don't have a trade here for the US dollar versus Canadian dollar. It looks like it's going to churn a while. You can see that right now, this this currency pair is in a bearish mode. It's below the 50-day moving average. And I just want to see what's going to happen. Either I buy on, short on further weakness, which is a new low here, or I buy on a breakout of 50-day moving average. Now, prior to this, the big assumption I had, you can see all of my notes here, is that this it's not just a trade war, actually. The US and Canada have a full all-out economic war going on. My assumption was that it would be positive for the US dollar. But after the trade pause, the dollar collapsed against the Canadian dollar and all sorts of other currencies, as trust in our currency has been going way down over the last several months. So now I don't have a specific, like I said, I don't have a specific trade just because it looks like there's going to be some consolidation as traders try to figure out, okay, is this collapse in trade talks real? Is it any more real than all the trauma and noise we had earlier? Or is this just going to be another one of these blips along the way to whatever resolution's on the way? So I'm just going to look at the technicals, not going to try to guess or project how these trade talks will unfold. And why do I say are traders and who knows, investors are losing faith in the US dollar? Well, this is, what's happened basically all year. The dollar peaked very early on in 2025. This is the dollar index. Now, a lot of this is because of the strength of the euro against the dollar, but you can see it hit a 3-year low at the depths of the tariff trauma, drama, and noise. And then it's been coming way down as I think this is now budget related as we're about to blow a big hole in the budget deficit with the current bill that's on, sorry, the budget bill that's on the table. And you can see here this week, very important, the US dollar broke below that support, which was the previous 3-year low. So let me pull back to show you just how bad this is. You can see that there was a nice breakout earlier. Actually, the breakout was really here back in 2022. And then the dollar cooled off and then just proceeded to go nowhere. So this breakdown is pretty serious. And assuming there's not a quick rebound, we could be in store for the dollar coming all the way down to retest the lows from the pandemic, incredibly enough. Sorry, the post-pandemic lows. So this is just something to keep an eye on because at some point the stock market sure hasn't cared at all about this, but at some point I think the stock market will care about it. So we'll see when that happens. All right, so thanks for hanging in there this long. I know this was a very long one, but there was a lot to talk about. There are so many other charts that I did not show that I could have shown. And let's just see what happens this coming week. Again, the theme is there's a confident calm now in the stock market and the all-time highs play that out. But keep alert, stay alert that it's possible that this bearish divergence that I showed in market breadth could flag the next pullback. So let's just keep our eyes out, be careful out there. And again, thanks for hanging in there and check you out the next time. You can always read the blog for more details. Take it easy.